Hey guys, welcome back to the channel. And before we get started, if you're enjoying this series so far, then be sure to hit that like and subscribe button, as it really does help us out a lot. So in this video, I'm going to be covering the different types of trading styles that are commonly seen within the financial markets, and how you can tailor your trading system to the type of trader that you want to be. So without further ado guys, let's get into today's video. First and foremost, let's consider trading styles based on the type of trading system being used, which can be split into discretionary, mechanical and HFT. First, let's look at a discretionary trading style. Discretionary trading is when a trader plans, executes and manages positions based on their own judgment. Of course, discretionary traders will still have a trading plan, but many aspects of their trading system will be dependent on a trader's feeling or intuition, which will ultimately determine which setups that trader enters and which they don't. The most popular technical analysis tool for discretionary trading systems includes support and resistance, structure, Fibonacci and trend lines. We actually cover more about discretionary trading in our Why Your Trading Strategy Sucks video, which I've left a link in the description to. So now we have discretionary trading ticked off, let's consider mechanical trading systems. Mechanical systems do exactly what they say on the tin. They make your trading more mechanical. However, despite what you may think, these trading systems do not actually require you to be a god tier programmer. You actually need to be able to follow simple rules. The key difference between discretionary and mechanical systems ultimately comes down to the use of a trader's intuition. A discretionary trader will use intuition, whereas a mechanical trader will prefer to completely eliminate this, instead creating rules for every eventuality when they're trading, and then they will always use these rules and stick to them. Now you're probably sitting there thinking that this sounds all too complicated and way too much hassle compared to discretionary trading. In reality, it really isn't. A simple mechanical trading strategy could be using a moving average crossover strategy on an instrument likely to appreciate in the long term. For example, an index like the Dow Jones or the Nikkei 225. Finally, let's consider HFT trading, which stands for high frequency trading. Many of the people watching this video probably aren't all too familiar with high frequency trading, and this is for good reasons. HFT is primarily used by large institutional investors such as investment banks and hedge funds. And it's essentially the process of algorithmic trading where financial instruments are bought and sold at super high speeds. Although inaccessible to most retail traders, it is very important to understand about high frequency trading, as these trading bots make up a large proportion of the volume traded in the markets, and they play a huge role in the effective understanding of how a market's order flow works. Although we have a video coming up soon about HFT trading, I would thoroughly encourage everyone watching this video to check out Liam Vaughan's book Flash Crash, as it's really good and provides an insight into the world of HFT, and an overall really good read. If you're interested, I've left the link in the description to Audible, where you can get a 3-month trial so you can listen to Flash Crash when you're on the go. Now we've covered the types of trading systems, let's consider trading on different time frames. We will start with the classic type of trader that everyone wants to be when they start, and that of course is the scalper.
And I want my scalps.
Scalping is the most short-term form of trading. Scalp traders typically only hold positions for seconds or minutes and target small intraday price movements. The primary aim for a scalp trader is to have a higher volume of trades with a smaller amount of profit per trade. The scalper will let those smaller profits build throughout the day and will typically only trade major currency pairs such as EURUSD, GBPUSD and USD/JPY due to their high trading volume and liquidity. To be a profitable scalper, you will need to find a good strategy first of all, but you'll also need to use a broker that has tight spreads and trade during the busiest times of trading day to ensure the markets are as liquid as possible. Trading at this time of day will ensure there's no slippage, and when you're entering positions, your order will be filled at the intended price. Beginners will typically gravitate towards scalping as it's really high paced and can seem like a lot of fun. However, if you're not experienced and don't have a strategy, then actually you can get burned pretty quickly. It is far easier to transition to scalping after being successful on the longer term timeframes rather than just starting on the scalping timeframes. Now let's consider a slightly longer style of trading, which is intraday trading. Intraday traders enter and exit their positions within the same day, as the name would suggest. The rationale behind this method is to remove the inherent risk of holding your trades overnight when you're unable to monitor them and be reactive to price. When day trading, traders will typically hold positions for several minutes to several hours, and will always place an emphasis on being flat by the end of the trading day. To be profitable when day trading, you typically need to combine a mixture of both fundamental and technical analysis techniques. It's common that traders will make a preference on which type of analysis they'll focus on, and for the team here at FX Education, we base most of our positions primarily on technical analysis, whilst also having a good grasp on what is occurring within the news. Developing an intraday trading strategy is very popular amongst traders who have other commitments such as a full-time job, as you're not required to be as reactive to price when compared to a method of trading such as scalping. Swing trading is a style of trading that attempts to capture short to medium term trades, which can mean holding trades for over multiple days or even weeks. The idea behind swing trading is that the risk posed by overnight exposure is less than the potential rewards of holding trades for much longer. This is an attempt to milk the trend for maximum profits. Many intraday traders will still consider themselves swing traders, so bear this in mind as the difference between intraday and swing trading is much less clear than the other types of trading. Now let's consider the longest style of trading, which is of course position trading. Position traders are focused on long-term price movement and will aim to profit from major shifts in an asset's price. It's common for a position trader to be active for weeks, months, or even years. Position traders will generally look at both fundamental and longer-term technical analysis and aren't generally interested or concerned by minor price fluctuations and pullbacks, which essentially means that their positions, once entered, are only monitored occasionally. So guys, there you have it, a full explanation of the different types of trading that you will see in the FX as well as the other financial markets that are traded. If you liked the video, then once again hit that like button and be sure to turn the notification bell to be notified when we upload the next lesson as part of the 365 Days of Forex series. Cheers guys, and I will see you in the next one.